Hello Terry, welcome. It's the year 2006 and you've just won 15,000 Canadian dollars from the Fields Medal. Now,
we are investors and this is what we do. We invest your money in what we think will perform well. We take the dividend payments as our compensation, and this covers all of the associated fees and with investing. We've prepared two investment options for you to choose from. Now option one is the safe option. It has two parts, 50% into the FTSE 100 and 50% into gold. Now the FTSE 100 is an index of the 100 largest companies listed on the London Stock Exchange. The money you invest is split among them based on how big each of those companies are. And the FTSE 100 is very stable as it includes only large companies which tend to survive global recessions and reflects the British and the global economy. Now there's also gold or gold stock. And there is a limited supply of gold which is in very high demand, and it tends to be quite stable because it doesn't rely on governments or companies, which protects it during recessions.
Now option two is the risky option. This option also has two parts. 50% will be in Apple and 50% will be in Nvidia. Now Apple, they're a large company known for innovations such as the iPod and Mac computers. They've seen significant growth since 2004 and we predict that it will dominate in technology in the future. Now Nvidia, they produce GPUs or graphics processing units. Now these are essential in computers and in other tech-related fields, and Nvidia is the industry leader of production of GPUs, so we predict they will play a large role in the future of technology. Terry, you falling asleep? Terry, wake up! Hello Terry, welcome to the future. The year is 2025. It's been 19 years since you had that investment meeting, and we're going to show you how those two options would have performed. So this is the table for option one. Keep in mind this was measured at the end of the year in Great British pounds. We have the percentage change from 2006 to 2025 of the FTSE 100 and gold. As you can see, bit of a dip there, bit of a dip there. That's the 2008 financial crisis and the 2020 global pandemic. Now we calculated the cumulative percentage change for both of these with this formula, which in decimal multiplies as this, rearranging gives us this. And we did that for all of these values right here. And then we combined them by just taking an average as the investment was split 50-50. Now, this is the graph of the FTSE 100 cumulative percentage change. This is the graph of the gold cumulative percentage change, and then this is the combined cumulative percentage change graph. And this peaks at about 280% in 2025. Now, for the calculations, we're obviously going to convert to Great British pounds, and with the exchange rate in 2006, that gives us roughly £7,000, which then, if you calculate the final value of investment by taking the decimal multiplier of the combined cumulative percentage change, gives us about £27,000. And back to Canadian, with the exchange rate in 2025, gives us 50,000 Canadian dollars.
Now, with option two, the only difference in our methodology was that we measured at the end of August, and this time was in US dollars because we're investing in US companies, right? So as similar drops in 2008, similar drops in 2020, except the numbers are much bigger towards the end due to the AI bubble. So as you can see, if we look at the graph, there's been a huge increase in value in Apple, around 10,000% cumulative percentage change over the period, and with Nvidia, over 40,000%, which leads to an average of around 25,000% for option two. And similar to the methodology before, like I said, we had to convert the exchange rate of the USD in 2006 into an initial investment of about $13.5K, and the final investment of 3.4 million at 2025 prices of USD. Now, converting back to Canadian dollars, we then had 4.7 CAD. But the issue was there's a lot of inflation of that period, and using a similar methodology to how we did the cumulative percentage change of the investments, we were able to get a cumulative inflation rate of 50% over the period, which means that around a third of your purchasing power has been eroded over that time period. So that's a very important factor when looking into your decision.
Yes, I'm Terry, you're falling back asleep, you're going back to 2006, oh! Oh, Terry, you've finally woken up, we're in the year 2006 like we always were. Now, have you decided on the two options? Do you want option one? What about option two? Oh, okay, we'll go with option two.
These are the references we used for all of our data, and this is the list of people who worked on our project.
Thank you, Terry.